Welcome to Breaking News to Trading Moves. We are opening the file today on a transaction that has captured everyone's attention: the acquisition of Warner Bros. Discovery by Netflix. This move combines two absolute content powerhouses, and it really redraws the competitive environment in Hollywood and across the global media space.
Yeah.
For anyone trying to understand the market implications, it seems like the first step is to really assess the winners and the losers.
Right. And to do that, we should probably establish the facts first. Let's just look at the core metrics of this deal. So the target company, that's Warner Bros. Discovery, which trades under the ticker WBD, was acquired by Netflix, ticker NFLX.
NFLX. Got it.
It was structured as a mixed cash and stock deal, but the crucial numbers here are about the total valuation. The equity valuation placed on WBD was an extraordinary $72 billion.
$72 billion, and that's just for the stock. That's a staggering commitment.
It is. And, that's only part of the story. If we account for the existing debt that Warner Bros. Discovery was carrying, which was substantial, you might remember, after its own previous merger activities, the total transaction value, so the overall cost of ownership, goes over $82 billion.
$82 billion, with a B.
With a B, that kind of financial commitment illustrates the immense, almost existential value that the market is placing on the assets being transferred here.
And when we talk about those assets, we are talking about some of the true crown jewels of global intellectual property, or IP. Netflix, ticker NFLX, was already a giant, controlling phenomena like Stranger Things and Squid Game.
Okay.
But now they gain control of a library that's historically proven and just so deeply embedded in our culture.
Oh, absolutely.
We're talking about the entirety of the DC universe, the entire Harry Potter franchise, and crucially, that massive, prestigious archive of HBO series. Everything from The Sopranos to Succession. The combined scope of what they now command is...
Well, that's unprecedented.
And that scope, it translates directly into quantifiable market power. If you just tally up the subscriber counts from both of their direct-to-consumer services, the combined footprint from this merger, it pushes the new entity to more than 420 million streaming subscribers worldwide.
420 million, that's the number.
That is the crucial number. This total places the new Netflix far, far ahead of any rival in terms of sheer subscriber numbers. It doesn't just make them the leader, it solidifies them as a colossus in global distribution.
Wow.
They're now in a position to dictate terms on content licensing, on advertising, maybe even on pricing.
So this deal really is the climax, the content ownership wars we've been watching for years. A multi-billion-dollar acquisition, fusing two content behemoths into one 420 million subscriber powerhouse. Our mission today is to quickly get past that headline and zero in on the core market reaction. When a transaction of this magnitude closes, the market immediately starts sorting winners from losers. It's all based on the perceived competitive advantages or disadvantages that arise from this new entity. So we're going to examine the market's rationale for which companies suddenly find themselves in a favorable position and which ones are now looking over their shoulder. Okay, so let's move right from the deal metrics to the market's immediate assessment. We can start with those companies that are seen to be in a favorable position, either benefiting directly from the transaction or, indirectly because it validates their whole business strategy.
The first and most obvious group is what we can call winner group one. The deal pair themselves. So that's the acquiring streaming giant Netflix, ticker NFLX, and the target Warner Bros. Discovery, ticker WBD. They are the direct, immediate beneficiaries.
All right, let's break down the rationale for Netflix first. Why is spending $82 billion, including absorbing all that debt, considered a winning move by investors? After all, Netflix has historically, they've prided themselves on organic content creation. This is a big change for them.
It is, but the rationale here is a massive bet on scale as the only true survival strategy in this modern media economy. For Netflix, NFLX, this acquisition is seen as consolidating their market power in, I'd say, three critical areas that organic growth alone just couldn't achieve quickly enough.
Okay, 3 areas. What's the first one?
The first is the content moat. Owning DC, Harry Potter, and HBO ensures that they are no longer dependent on expensive third-party licensing deals. That immediately cuts their future operating costs while at the same time increasing the quality of their exclusive library.
So, the argument is that the long-term savings on licensing, plus the guaranteed subscriber retention from owning this kind of essential IP, that it justifies the massive upfront cost.
Absolutely. Think of it as purchasing insurance against content scarcity. The second area is that it drastically speeds up their ability to dominate the global advertising market. With 420 million subscribers, their new advertising tier instantly becomes a must-buy for major global brands.
Right. They can now offer an audience that no one else can match.
No one can match it. They have this highly diversified and massive audience, which gives them immediate pricing power in what's become the streaming advertising wars.
And what's the third point? I think you mentioned an international angle, which often gets overlooked in these big deals.
Precisely. International market saturation is looming, and the only way to squeeze out new growth is either to acquire regional or hyperlocal assets, or to offer such overwhelming content value that new markets just adopt your service instantly. This combined catalog, particularly the global appeal of franchises like Harry Potter, provides instant legitimacy and retention power across every major non-domestic market. It effectively future-proofs their subscriber numbers against any regional competitors. It's the ultimate move to consolidate economic power and solidify long-term pricing leverage.
Okay, that makes sense for the acquirer. Now, what about the target's shareholders? Warner Bros. Discovery, ticker WBD. It seems obvious they received a benefit, but what specifically made this deal a winner for their investors?
Well, for the existing shareholders of WBD, the benefit is very concrete. It's the substantial premium valuation they received. A deal of this size isn't executed at the current trading price. The acquiring company has to offer a price above where the stock had been trading to incentivize shareholders to approve the sale.
And given the, let's say, complex history of WBD and its management changes, this was probably a welcome offer.
A very welcome offer. Receiving a valuation of $72 billion for the equity, which translated to a large premium over the 30-day average price, was seen as an excellent exit.
And crucially, this was structured with a cash component, right? So it gave shareholders immediate liquidity.
That's key, yes. They exited their holdings with a clear, established value. They liquidated their investment at a favorable price that really capitalized on this intense, almost desperate demand for content assets we're seeing. Furthermore, that massive debt burden of WBD is now off their balance sheet and absorbed by Netflix. That makes the transaction a definitive financial success for the legacy WBD investors who get a clean return on their capital.
That sets a very high bar for the entire media sector. Which I guess brings us to our second group of winners. Winner Group 2, big IP and global streaming peers. Here we're talking about companies that weren't even involved in the transaction, but whose valuations are strongly supported by the price Netflix paid. Specifically, Walt Disney Company, ticker DIS, and Amazon, AMZN.
Exactly. This group's benefit is entirely about market perception and valuation mechanics. The $82 billion transaction value for WBD provided what's called market validation. It established a real-world current benchmark for the value of deep content libraries and established global streaming reach. The rich price paid for Warner's franchises confirms to the entire investing world that this specific asset-type global IP is exponentially valuable.
Let's break down that concept of re-rating, because I think it's a critical insight for anyone listening. How does the WBD deal force the market to reevaluate the price tag on Disney and Amazon?
It starts with what's called a comparable analysis. Investors use metrics like, say, enterprise value to revenue multiples, or even something simpler like enterprise value per subscriber. Before the NFLX WBD deal, the market might have applied a cautious multiple to media companies because of rising content costs. But this deal provides an undeniable recent data point. The valuation floor for a premier diversified media conglomerate is extremely high.
Okay, so if the DC and Harry Potter universe, alongside that HBO catalog, is worth $72 billion in equity plus all that debt, how does that then apply to Disney?
Well, Disney, ticker DIS, owns what are arguably even more irreplaceable assets. Marvel, Star Wars, Pixar, and their own massive back catalog. And all of that is deployed across their globally scaled Disney Plus platform. The market rationale is clear. If WBD's portfolio commands an $82 billion valuation, then Disney's portfolio, with comparable or maybe even stronger global brand recognition and merchandise potential, it must at least maintain, if not immediately see, an uplift in its valuation multiples.
So it's a re-rating. The whole peer group gets repriced based on this new, higher benchmark set by Netflix.
That's it. The price tag becomes the proof of concept for the valuation strategy, confirming that the content ownership model championed by Disney is worth the steep investment.
But wait, doesn't Amazon AMZN operate with a different strategy? They use content primarily to drive Prime membership retention, not necessarily for streaming profit. So why should their valuation also benefit from this massive media merger?
That's an excellent point, and it injects the nuance needed here. While Amazon's core business is different, their benefit is derived from the quality of the IP they own. You see, Amazon, ticker AMZN, has invested heavily through Prime Video and especially through the acquisition of MGM. The WBD transaction validates the cost of buying premier content. If Netflix is willing to spend $82 billion for WBD, it signals that acquiring established studio libraries like Amazon's MGM portfolio is not a luxury. It's a necessity to compete at the highest level.
In other words, the high price paid for WBD ensures that Amazon's large investments in content are now seen by the market as judicious and maybe even undervalued relative to this new standard.
Exactly. It confirms that their foray into content ownership through Prime Video, which supports the entire Amazon ecosystem, is strategically sound, and the value assigned to their IP assets has been implicitly raised by the benchmark Netflix just established. It benefits their confidence in continued content investment.
That's clear. The price paid for WBD effectively sent a rising tide across the whole media sector. Okay, so let's look at winner group 3. Media names seen as future takeover candidates. This group consists of smaller, or I think the term is subscale media groups.
Yes, and we're focusing here on companies like Paramount Global, ticker PARA, and AMC Networks, AMCX. They might seem like unlikely winners in a consolidation trend, but the market views them favorably because the NFLX WBD transaction has created a new urgency among all the remaining competitors.
What exactly does subscale mean in this new 420 million subscriber world, and why does this consolidation actually help them?
In the current environment, subscale generally refers to a company that lacks the global reach, the financial resources, or the IP depth that's necessary to compete effectively against the giants without some kind of external help. They might have niche audiences, but they lack the tens of millions of subscribers required to achieve profitable streaming economics and support high-cost content production.
So consolidation accelerates the need for scale, and if you're small, your only value is either being bought or breaking yourself apart to sell the pieces.
That's the two-part thesis, exactly. First, there's the takeover premium. This consolidation confirmed that the M&A trend is accelerating. Larger remaining players, or maybe tech giants who missed out on WBD, will now view a PARA or an AMCX as an essential, quick acquisition to bridge the scale gap with the new Netflix giant. The high price tag of WBD suggests that any media company with valuable proprietary assets, regardless of its current operating performance, will command a premium.
Can we get specific about the assets held by a company like Paramount Global, PARA, that might suddenly become more attractive targets?
Absolutely. Paramount Global, for instance, owns a legacy movie studio, key broadcast networks, and, crucially, a sizable library and some important niche content like suit and sports rights. A company that's looking to build scale quickly might target specific assets within PARA, say its production facilities or its international distribution backbone, to integrate into their own structure. The market sees the potential for a bidding war, which inherently increases PAR's perceived value simply by existing in this newly competitive environment.
And the second part of the thesis, you mentioned the breakup story.
Right. So if these subscale groups can't find a buyer willing to pay a suitable premium for the whole company, the pressure from activist investors dramatically increases to separate and sell off individual high-value assets. If the market assigns an $82 billion value to the component parts of WBD, then the valuable component parts of PARA or AMCX are also viewed with increased scrutiny. Think of specific networks, a profitable back catalog of classic shows, or a strong regional news operation. The sum of the parts could be worth more than the whole company is currently trading for. And this pressure to unlock value, either through an external acquisition or internal restructuring, positions their shareholders for potential future gain.
It's the ultimate validation for the smaller players, in a way. They become valuable precisely because they are necessary components for the remaining giants, trying to catch up with the 420 million subscriber leader. We've established a clear view of the winners, whose business models or valuations have been validated by this enormous transaction. Now, however, we have to turn our attention to the other side of the ledger. When a combined entity of this power and scale is formed, it inevitably creates new existential competitive pressures for others in the ecosystem. So we're pivoting now to the sectors and companies categorized by market observers as facing new challenges, starting with the traditional distribution world.
And that brings us to loser group 1, legacy cable and satellite distributors. These are the companies that have historically relied on the traditional pay TV bundle for their revenue and subscriber retention. We're talking about major players like Charter Communications, ticker CHTR, and Dish Network, DISH.
The narrative has been that cable is dying for years now. How does this specific Netflix acquisition move the needle from, slow decline to accelerated threat?
Well, it forces a climax in what you could call the clash of models. The fundamental power dynamics of media distribution rested on a historical balance. Content creators needed cable companies for reach, and cable companies needed content creators for channels that justified the high monthly bill. Before this merger, WBD content was still partially tied to the traditional bundle through cable networks like TBS, TNT, and of course the lucrative premium HBO add-on.
And now?
Now, Netflix, NFLX, controls that entire slate, and Netflix's core exclusive focus is the direct-to-consumer model. The incentive for them to prioritize the streaming side, which they fully own and which generates data and ad revenue, directly increases dramatically. This means the content that used to justify the high cost of a comprehensive cable package is now fully consolidated under one streaming roof that is explicitly aggressively competing with those distributors.
So how does this consolidation specifically weaken the long-term negotiating leverage for companies like Charter, CHTR, or Dish Network, DISH?
It degrades the perceived value of their offering. For decades, the power of a distributor lay in their control of the customer and the physical pipeline. They could threaten to drop a content network if the demands for carriage fees were too high. This threat worked because content suppliers relied on the guaranteed revenue from millions of bundled customers.
But Netflix doesn't need that guaranteed revenue anymore because they have 420 million direct relationships already.
Exactly. The game has changed. If the new Netflix WBD entity decides to pull content exclusivity entirely, say, removing popular back catalogs or key sports rights from their traditional channels and making them streaming exclusive, the cable distributor's offering immediately looks weaker. When CHTR or DISH come to the bargaining table to negotiate carriage fees, the new content powerhouse is far less compelled to maintain the traditional arrangement. They have a dominant, self-owned alternative distribution channel.
So the negotiation flips on its head. Instead of the distributor holding the power of access, the content provider now holds the power of exclusivity.
Precisely. This erosion of desirable exclusive content is highly damaging. It accelerates the existing cord-cutting trend and, crucially, it caps the ability of these distributors to maintain their high-margin pricing structures or their subscriber levels over the long term. Their traditional business model is dependent on the perceived exclusivity and value of the bundle, and this deal severely reduces both, making them clear losers in the transaction's fallout.
That makes the future look very complicated for that legacy distribution framework. Moving on, loser group 2 shifts us to another part of the pipeline, movie theater chains. Here we're looking at businesses like AMC Entertainment, ticker AMC, and Cinemark, CNK, whose revenues are directly tied to traditional long theatrical windows.
The market places these exhibition companies firmly in the loser category because the consolidation raises some profound risks regarding release strategy. We have to remember that even before this merger, Warner Bros. Had already signaled a willingness to experiment with shorter theatrical windows. Now the entire Warner Bros. Slate, which is a crucial source of blockbuster films, is owned by the world's largest streaming platform.
And the strategic incentive for this new entity is entirely aligned with feeding its 420 million subscribers, not with supporting third-party exhibitors.
That's the core tension. The first risk is the acceleration toward drastically shorter theatrical release windows. While theaters depend on a 60 or 90-day exclusive window to maximize their box office haul, the combined Netflix WBD entity is incentivized to shrink that window to perhaps 30 days, maybe even less. They do that to drive new subscriptions and increase subscriber retention immediately after the box office run. The sooner they can put that content on their platform, the more value they generate for their core business model.
And the second risk, which seems even more damaging, is the potential for an increase in the number of high-quality titles going straight to streaming, skipping theaters altogether.
Absolutely. Netflix's business model, that's NFLX's model, is based on lifetime subscriber value. A high-quality Warner Bros. Film that might have previously guaranteed a $300 million theatrical run might now be repurposed to anchor the streaming schedule, preventing 5 million subscribers from canceling that month. If the strategic team determines that avoiding churn and driving 5 million new signups is economically superior to the profit from a lengthy box office run, they will choose streaming every time.
So how does this cap the recovery potential for the exhibition industry for AMC and CNK?
Well, their recovery relies entirely on a consistent pipeline of event movies with guaranteed exclusive theatrical runs. The combined entity now controls a substantial portion of anticipated blockbuster films. I mean, the DC Universe alone is a calendar filler. If that content stream becomes volatile, or if its exclusive window is severely compressed, it drastically limits the revenue potential per film for the theaters. Furthermore, it undermines the fundamental consumer psychology that drives moviegoing. If you know a major film will be available on your subscription service in 30 days, it removes the urgency to see it opening weekend, which is vital for theater profit margins. The strategic decisions are now entirely skewed towards optimizing subscriber benefit, reducing the box office to an optional secondary revenue generator for that content.
A clear conflict of interest for their former supplier. Okay, now let's analyze Loser Group 3, smaller pure-play streaming platforms. These are the companies focused solely on streaming that simply do not have the breadth of proprietary content necessary to compete with this new powerhouse. We're talking about platforms like Roku, ticker ROKU, and Fubo TV, FUBO.
This is a complex situation because these companies are already struggling to achieve profitability. Now they face a much larger, consolidated opponent with an almost impenetrable content moat. The core issue for Roku, ROKU, and Fubo TV, FUBO, is achieving profitable economics in both content and advertising.
And if a consumer is managing their monthly entertainment budget, how does a smaller niche offering justify its cost against the overwhelming value offered by the 420 million subscriber giant?
It becomes incredibly hard to argue for indispensable value. The smaller platforms have to fight for every single subscriber and every single advertising dollar. And you look at the challenge for Roku specifically, while Roku is primarily a distribution platform, they rely heavily on their own content channel economics and their ability to capture advertising inventory from third-party streamers.
And how does the new Netflix entity directly undercut Roku's core revenue models?
Well, the new Netflix giant, being vertically integrated and controlling vast amounts of exclusive in-demand content, will focus on selling its own advertising inventory first and selling it at a massive scale. If Netflix can guarantee millions of views across premium content, it captures the lion's share of the advertising budget, leaving less money for smaller players. Moreover, if Roku's partners are all struggling to compete with Netflix, they're going to spend less on Roku's ad inventory or licensing deals. The consolidation of content in the hands of NFLX dramatically reduces the economic leverage of ROKU as a content aggregator.
And for a content specialist like Fubo TV, FUBO, which relies so heavily on live sports and other specific niche offerings,
Fubo TV faces the same content expenditure pressures, but without the diversified revenue streams of a giant like Amazon or Disney. They have to license content, usually live sports, at exorbitant rates. When the mega streamer, Netflix, increases the competition for every single consumer dollar, the smaller players have two choices. They must either significantly increase their content spending, driving them further away from profitability, or they have to specialize so narrowly that their potential market shrinks considerably. The challenge isn't just winning subscribers, it's winning them profitably against a behemoth that can essentially run content at a loss if it means starving the competition. They lack the content ownership and the diversified assets required to withstand the economic pressure applied by the 420 million subscriber powerhouse.
this acquisition of Warner Bros. Discovery by Netflix is more than just a transaction. It's a profound statement about the future of the media landscape. Our analysis today really illuminates the core tension driving the modern media economy. The enormous, arguably unparalleled value of intellectual property, matched only by the necessity of achieving global scale. The combined entity boasts a subscriber base of 420 million, placing clear, immediate pressure on those players who are deemed subscale or who rely on outdated distribution methods.
Absolutely. The $72 billion equity price for WBD forces every executive and every investor to recalibrate their understanding of IP valuation. If established franchises like DC and Harry Potter, alongside the deep archives of HBO, command that kind of valuation even when bundled with substantial existing debt, it strongly suggests that the future strategy for all players must prioritize ownership and absolute exclusivity of durable IP. The market has delivered a clear message. You have to control your own destiny by owning the content the audience demands.
So if the market has placed such a definitive high price tag on these iconic, well-known franchises, what does that suggest about content strategy moving forward? We know about DC, Marvel, Star Wars, but what other categories of media assets beyond the most famous franchises might become the next essential targets that players will chase?
That's the key question. It suggests the chase will move aggressively into two areas, what you might call high-volume, defensible content categories and gateway IP. We might see an increased focus on proprietary gaming IP, for instance, that offers new revenue streams and highly engaged younger audiences that can be migrated to the streaming platform. We may also see large bids for deep catalogs of highly binge-worthy, classic television that offers comforting volume and predictability. The lesson learned from the WBD valuation is that content must either lock down a niche market or offer sufficient volume and quality to make your platform truly indispensable. That $72 billion valuation is not just a price, it's a blueprint for the next wave of essential acquisitions.
A compelling analysis of how one massive deal can redraw the competitive map instantly. This is not financial advice or buy or sell recommendations. This is purely the opinion of the author.